Hi, this is Taylor Pankratz, co-founder and president of Holistic Planning, and today we're going to talk about things to consider when deciding whether you should roll your 401k into an IRA or leave it where it is. What does it mean to roll over your 401k? This simply means to transfer your 401k funds to an individual retirement account, an IRA, in your name. It's important to understand this is a non-taxable event, so there's no tax implication to doing this, but your specific situation should dictate whether this makes sense for you or not. So this conversation we have with clients all the time, and we often encourage people that have a 401k to think about the costs, convenience, customization, and control when making this decision. So first, let's look at cost. Does your 401k plan have high cost investments or fees? Many large 401k plans offer low cost options that have been carefully vetted by the plan's administrators, but other 401ks are hobbled with underperforming funds and high costs. Some plans, specifically with more small and mid-sized companies, are loaded with insurance products that charge a tremendous amount of fees. IRA accounts will also have investment fees, which are based on the specific investment options you choose and are typically comparable to the investment fees of low-cost 401k options. So now let's talk about convenience. Do you want your money to be consolidated? If you've changed jobs frequently, let's say you left your old 401k plan behind, well, this could result in a mismatch of overlapping funds that may or may not suit your age and risk tolerance now that you're older, right? In that case, it can make sense to consolidate all of your old 401k plans into an IRA. Another option would be to roll the old 401k plans into your existing 401k plan if that's allowed. Just think of it as we want to bring this money with us wherever we go. The next thing to think about is customization. Do you want more investment options? Although most 401k plans have a solid lineup of stock funds, they're often much weaker when it comes to fixed income options. In many cases, choices are limited to money market fund, a bond index fund, and maybe an actively managed bond fund. Most plan trustees are focused on encouraging participants to accumulate as much as they can, which typically involves investing in stocks. As you get close to retirement, though, and closer to distribution mode, you'll probably want to shift to a less aggressive mix of investments. So rolling your money into an IRA will provide you with a more fixed income options or better fixed income options to create a more consistent cash flow that you can live on from your nest egg. The last piece is control. Do you want flexibility for withdrawals? About 2/3 of large 401k plans allow retirement participants to take withdrawals in regular scheduled installments, think monthly or quarterly, for example. But other plans still have an all or nothing requirement. You either leave your money in the plan or withdraw the entire amount out. In this case, rolling your money into an IRA will help you manage your withdrawals and, of course, your taxes, because you, of course, pay taxes on any money that you pull out of your 401k that goes to your bank account. And even if your 401k plan allows for regular withdrawals, an IRA could offer more flexibility still. Many 401k plan administrators don't let you specify which investments to sell when you want to send yourself cash. Instead, they take equal amounts out of your investments. They call that pro rata. This is obviously not ideal, but with an IRA, you can specify which investment to take the necessary cash from. Let's say the stock market is down and you want to take the money from your fixed income allocation and let the rest of your stock market money continue to stay invested to avoid selling at a loss. That's not always possible in a 401k, but is definitely possible and encouraged in an IRA. The next question to think about in terms of control is, do you plan to retire early or late? In general, you must pay a 10% early withdrawal penalty if you take money out of your IRA or 401k before you're 59 and a half. There is, however, an important exception for 401k plans. Workers who leave their jobs in the calendar year they turn 55 or later can take penalty-free withdrawals from that employer's 401k plan. But if you roll that money into an IRA, you'll have to wait until you're 59 and a half to avoid the penalty unless you qualify for one of a handful of exceptions. Keep in mind that you'll still have to pay taxes on that withdrawal. Now, if you plan to work past the age of 73, ordinarily you must take required minimum distributions from your IRA and 401k plans starting in the year you turn 73. But if you're still working at age 73, you don't have to take RMDs from your current employer's 401k plan. And if your plan allows you to roll over money from a former 401k plan into the existing one, you can also protect those assets from RMDs as well until you stop working. So that's one quite large advantage of leaving your money in a 401k if you're wanting to work past the age of 73. Next one is, do you plan to do Roth conversions? Most 401k plans don't allow in-plan Roth conversions to a Roth 401k. So if you plan to do Roth conversions to try to lower your lifetime tax bill, typically your only option is rolling the funds into an IRA. Roth conversions are becoming very popular as people weigh the likelihood of future tax hikes, and even more popular with recent retirees that plan to delay Social Security until they have converted a good chunk of their IRA or 401k so they can keep more of their Social Security check in the future from going to the IRS. The next question to think about is, do you want to invest in a Roth IRA but earn too much to contribute? Rolling over your former employer's 401k to an IRA could make it more expensive to take advantage of a strategy to move money into a Roth IRA. Now, high earners can make after-tax contributions to a non-deductible IRA, and for 2023, the max contribution is $6,500 or $7,500 if you're over 50, and then convert that money to a Roth IRA. And because the contributions to the non-deductible IRA are after tax, there's usually no tax on the conversion. Unless that is, you already have qualified money in an IRA, which you certainly will if you roll your 401k into the IRA. In that case, your tax bill will be based on the percentage of taxable and tax-free assets in all of your IRAs, even if you convert only one of them. So it's ideal to not have any qualified money in an IRA if you plan to do backdoor Roth IRA contributions. So that's the basics of what to consider when thinking about rolling over your 401k and if it makes sense for you. If you have any questions on any of this, please don't hesitate to reach out, as we would be glad to walk you through these options. You can find more information about us at holisticplanning.com and even schedule a meeting with us to see how we can add value to your life.